All right, welcome to this explainer. Today, we're going to break down the Nifty CPSE chart. We'll be using a really objective, step-by-step technical framework to completely unpack its current market structure. Let's get right into it. Here's our game plan. We're using a what so what now what framework. We'll start by reading the CPSE chart, look at the relative strength warning, test some critical support zones, weigh the bullish versus bearish scenarios, and finally, look at actionable trading setups.
All right, part 1, reading the CPSE chart.
So looking at the weekly view here, that blue line, the 40-week moving average, tells us the long-term trend is still firmly bullish. I mean, notice how the price has just ridden above this rising line for most of 2026? It pushed all the way from around 6,200 up to 7,500, seriously outperforming the broader Nifty 500 along the way. So right out of the gate, our primary trend? Definitely bullish. Moving on to part 2. The relative strength warning.
Now we hit the so what phase, looking under the hood at momentum. What's super interesting here is the contrast. You've got that strong long-term trend, but then look at the daily relative strength, or RS, rolling over. See that purple line tracking the RS at the bottom? While the big picture is intact, that short-term momentum indicator is painting a slightly more cautious picture.
To really get why this matters, we gotta look at the peak. Early in 2026, that relative strength line had a massive breakout, hitting the high of 0.31. But it's actually been dropping for several weeks since hitting that high. That tells us that, yeah, CPSE is still outperforming long-term, but its rate of outperformance is visibly hitting the brakes. So here's the golden rule of thumb. Rising means leadership, flat means neutral, and falling, that means losing leadership. Basically, a falling RS line is a giant yellow flag. Institutionally speaking, capital just isn't flowing into the CPC sector like it was earlier this year.
Which brings us to part 3, testing critical support zones.
With momentum slowing down, we got to find our battlegrounds on the price chart. Notice how the price just kind of chopped around and consolidated for months right at the 6,700 level? It finally broke above it, flipping that old resistance into support. Now, look really closely at the recent action. The latest daily candle closed almost perfectly on that line. This is our absolute first real test of that breakout zone.
All right, part 4, bullish versus bearish scenarios.
Look, technical analysis is all about probabilities, right? So we have two distinct paths here. The bullish case, the price successfully holds that 6,650 to 6,700 zone, builds a base, and the RSI turns back up. If that happens, it's just a totally normal pullback. But the bearish case, well, that happens if we get a decisive close below 6,650. That would signal a failed breakout.
And if that bearish scenario does trigger, and the RS keeps sliding, seeing a drop down to 6,400, or even 6,200 honestly, wouldn't be a shock. Those are your logical downside targets where buyers usually step in, and where a failed breakout would naturally gravitate. So you're probably wondering, is right now the time to buy? The objective answer is no. And it's not because the whole trend is wrecked, we already know the primary trend is bullish. It's simply because the reward-to-risk ratio just isn't there yet, not with falling relative strength and an untested support level. We absolutely need proof that the buyers are back. There's a great quote from our source material that totally nails this logic. I would rather pay 5% higher after confirmation than buy now and discover the breakout failed. It is so much safer to wait for hard technical evidence, rather than trying to catch a falling knife and blindly guessing where the absolute bottom is.
Okay, let's wrap this up with part 5, actionable trading setups.
Time for the now what phase. Setup 1 is your absolute highest probability entry, but it demands patience. Step 1, price has to hold that 6,650 to 6,700 zone. Step 2, we need to see a bullish weekly candle actually form. And step 3, this is the real key. The RSSI needs to stop falling and turn up. That confirms leadership is actually returning to the CPSE before you put your fresh capital on the line.
If you don't get that, you've got setup 2 or 3. Setup 2 is your classic breakout entry. You wait for the price to recover above the 7,200 to 7,300 swing highs while the RS makes a higher high. You're buying proven strength there. Setup 3, that's your deep value play. If current support totally fails, price drops to that 6,200 to 6,400 zone, and the RS stabilizes, suddenly your risk to reward looks fantastic again. This matrix right here is essentially the ultimate cheat sheet for the current environment. Long-term trend? Bullish. Intermediate trend? Correcting. Relative strength is weakening, which means leadership is losing momentum. The big takeaway for action? If you want a fresh entry, wait. If you already hold it from lower levels,
hold. The structure is a bit wobbly, but it hasn't completely broken down yet.
Seriously, if you only remember one thing from this explainer today, let it be this: uptrend intact, leadership fading, patience required. This is a wait-and-see chart, not a panic sell everything chart. It just takes a bit of discipline right now.
So as you're watching these charts over the next few weeks, keep your eyes glued to that relative strength line. Wait for it to stop dropping and make a higher low, because that is exactly what will answer our final question. Is CPSE resuming its market leadership, or is this just a temporary bounce? Letting the RS dictate your moves is the smartest technical play you can make here. All right, that wraps up our explainer. Thanks for hanging out, and keep your focus on the charts.